Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We'll be coming to you live from the Singapore Fintech Festival. And joining me for this segment, we have KC Lam. He's the head of FX and rates at the Singapore Exchange, one of Nasdaq's partners in the APAC region. We're going to take a look at risk managing Asian FX. KC, it's great to have you back on the show with us. And the obvious question is, how has the trade war impacting risk management in FX, particularly for institutional investors in the U.S. looking for opportunities in Asia?
It's a great question. I mean, if you look at the recent event, trade war, going cold and hot every now and then, there's a greater awareness among U.S. institutions on liquidity, how important that is, especially during U.S. hours. A very classic case in point would be on July 31st, where there was a trade talk in Shanghai. U.S. and Chinese officials were having a discussion. The outcome of it was a bit, should I say, quiet. There's no real official statement on terms of success of the trade. They all agreed to say that they're going to do more purchases of agricultural stuff. Next day, on August 1st, President Trump announced, that's like 1:30 Eastern Standard Time, that they're going to be a 10% tariff on Chinese goods coming in. That sent the market to a tailspin. And as you can appreciate, 1:30 US hours, is pretty much late in for Asia. But SGX actually showed very deep liquidity for the dollar CNH currency pair, which is important because that day itself culminated in a record trading day for us. 7.53 billion traded in notional terms, US notional term. So that was pretty amazing on August 2nd, in Singapore time. And what happened over the weekend was on Monday, PBOC, which is the Central Bank of China, came out with a fixing that's above 7. Now this rate, this level, has never been breached for the last 10 years. That sent the market into a very crazy spin, and we closed that day with a $10.3 billion notional traded, another record day for us. So very, very key to note that liquidity existed throughout the period of the trading, and that's where people are looking at SGX to do price discovery, to get our position, to get into position, to hedge the trades and so on. So,
I mean, we certainly understand it very well in the U.S. markets with trade headlines moving equities, and I can't even imagine what it must be like in Singapore trying to do that on a different news cycle, on a different sleep cycle. So it's really impressive that you've maintained that position. You've also retained your position as the world's third largest FX center. That's according to a recent Bank of International Settlement survey. What are you doing to strengthen your role in addition to liquidity in the FX space?
Well, there's two angles to this, right? Firstly, the country itself. Like if you look at Singapore, there's been a trading hub for commodities for all this while. Bunker fuel is the largest bunker fuel trading center in the world. Iron ore trading is rampant and active here. We also have a lot of commodity trading. Besides commodity, there's also a natural wealth management center. Singapore, with asset under management of $3.4 trillion US, it's actually one of the biggest in Asia for asset management. And all this basically leads to the question of how do you manage your foreign exchange exposure? And Singapore is well positioned to capture that. As you rightly pointed out, Singapore, the BIS study is ranked the largest FX center in Asia and the third largest in the world. And the MAS has cemented their position by also providing some incentive for big buy-side, sell-side, and technology firms to come and set up their trading centers in Singapore. Recently, we see Citibank, Standard Chartered Bank, UBS as signing up to provide liquidity as pricing liquidity from Singapore, as using Singapore as a hub. And then we have the likes of Jump Trading from the States, XTX from Europe, a venue like Euronext FX, setting up in Asia to basically as a trading center in Asia. That actually is positioning Singapore well. Naturally for SGX, which is based in Singapore, it's important for us to basically draw in the liquidity and draw in the participants. With the growing community of FX in Asia, it's just so advantageous for us to basically build a concentration of liquidity in Singapore. Singapore is well placed, if you look at it geographically speaking, to continue the trading hours to London, which is the largest FX center in the world. Singapore, if you look at connectivity from Singapore to London, is equidistant or pretty much the best optimal location for connection from China, up north or down south from Australia, New Zealand, India, Hong Kong. It's well placed right in the center to connect into London, and that's where FX is like. It's continuity of trading 24 hours a day, and Singapore being the very first important center to start that liquidity role.
All right, let's talk about the OTC markets. With global reforms to promote stability in international finance system, it's lended to a couple of unintended consequences in the FX market, such as the increased cost of OTC trading. So where's the opportunity lie for SGX there?
Well, it's rightly pointed out the unintended consequence. One of the things that the global reform did was to basically introduce accountability and transparency to the whole financial system and make it more resilient. SGX is well supportive of this, is very strongly supporting of this initiative because obviously it protects the consumers and make financial institutions more resilient. But with the increased cost of trading, banks are looking at liquidity coverage ratio, looking at the risk in counterparty risk, and all this basically adds up to the cost of trading in terms of cost of balance sheet. And with the introduction of uncleared margin rules, it means that institutions have to price additional costs to basically post initial margin and variation margin to the trades. This is actually going to be very costly for OTC participants. Ideally, what the OTC participant would love is to have the efficiency of an exchange traded futures, the ability to do multilateral netting, the ability to basically have good leverage on trading, as well as the safety and surety of exchange. And that can only happen if you have an innovation to basically develop new products around how trades are being done for FX. One of the things that Singapore Exchange did is introduce what we call Flexi Futures. Flexi Futures allows FX trades to be done 100 days from today, as long as it's a business day, and it's cleared as a futures. So it's the same thing as what OTC is, the flexibility of OTC with the surety of exchange. It's the best of both worlds. And we just rolled out this year, late last year, early this year. And last couple of days, we have seen a lot of trades. In fact, we have done, just last week, we've done close to $50 million of trade, just on the Flexi itself. It will take time as more clearing members need to get ready. But as soon as they get ready, more and more ability to basically change the way of doing things, this is actually going to take off in a big way.
All right, Casey, great to see you as always. Thanks so much for joining us. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.